Welcome to the C-Suite series on Channelchek. I'm Michael Kopinski, the Director of Research at Noble Capital Markets. Noble is the source of all equity research on Channelchek and the source for small and microcap companies. These are companies that may not be front and center on CNBC, but represent the heart of the North American economy. Of the 6,000 small and microcap companies listed on Channelchek, in this program, we're featuring Seanergy, stock symbol SHIP, SHIP. Noble analyst Pofrat will interview Tsantanis, the chairman and CEO. Seanergy is a shipping company owning a fleet of dry bulk vessels. The entire fleet are Cape-sized ships, the largest vessels that move mainly iron ore and coal. So why, as an investor, should you be interested in this interview? Investors can learn about global trade. With global trade adversely affected by the COVID pandemic, the question is, why have shipping rates recovered? And they're going up dramatically. As you'll learn from this presentation, it's not for reasons you might think. In addition, this was a stock that had a 3 in front of it, meaning not $3, but over $300 per share, just a short 2 years ago. Investors should gain insight on whether the worst is now behind the company. And secondly, if you'd like to get Poe's research on Seanergy, on channelchek.com, type in the symbol SHIP in the search box in the top left section of the site. And before I turn it over to Poe, I encourage you to stick around for closing comments when Poe and I will discuss the key takeaways from this interview. Poe, take it away.
Good morning, Stamatis. Thank you for joining us. Why don't we start with when we look at the overall macro environment that you're operating within, and then if you could just talk about how that macro environment has impacted the Cape market, that would be helpful.
Absolutely. First of all, the Cape size market is the largest size of the conventional dry bulk ships. The main commodities that we transport are iron ore and coal, and the main routes that we do are Brazil, China, and Australia to China. These are the main routes. The Cape-size trade is highly connected and associated with the global infrastructure demand. So while the COVID-19 situation in the beginning of the year, and I'm sure we will be discussing that later, has been detrimental for the global economies, given that the major governments in China, the US, and in other places will be investing heavily in infrastructure, we expect that to be highly beneficial for the Cape-size market.
Have you seen any shift in trading patterns, or when you look at your two main products that you move with iron ore and coal, have you seen any shift in trading patterns over the last year? And then looking forward, do you expect any shifts in those patterns?
Actually, the demand for iron ore has been very strong, and that is mainly driven from the Chinese market, where the economy has gone back into pre-COVID levels, and they are investing heavily in infrastructure. So demand for iron ore has been very strong. The only issues, I must say, in our trade have not been demand related, but supply of product. The supply of the actual iron ore was not sufficient to cover the required quantities in China. So this is what drove mainly, after the big crash of January, February due to the virus, what really drove the market downwards in the second quarter, starting from March, of course, and then into the second quarter, was the inability of the major miners and producers of iron ore to cover the demand requirements of China. So that's why the iron ore prices went up significantly, and this is why the port stocks in major countries have been very low, because there was not enough product to be transported. Right now we see that the market has normalized to that extent, but overall it's been a difficult situation because of the supply of the product. It was not demand driven, on the contrary.
Okay, and if you have normal demand and looking out over the next couple of years, I think myself included, but the analyst community generally looks at a pretty strong earnings for pretty robust earnings scenario over the next several years. Is that in line with your thinking, or how are you thinking about the next couple of years from a standpoint of the overall Cape market?
We are generally very optimistic, and this is why we are expanding our fleet with a recent acquisition. We strongly believe that the market is going to continue rising towards the historical levels. Just to put things into perspective, Paul, the long-term historical average of the Cape-size market is actually around $24,000 to $26,000 a day. The recent average over the last 5 years has been 12, and year to date, I mean from the beginning of the year until the end of the first half, the average has been 7. So we have been operating in a rate environment that is significantly lower than what is the long-term historical average. We strongly believe that the market is going to go through to that average soon. My main concern is not demand, because we strongly believe that the long-term fundamentals for the associated commodities are very strong, is how to keep up with the growing demand from various places that will be investing in infrastructure, as I mentioned before.
When you say keep up, it sounds like you're a little more concerned about the supply side, and that we're not potentially going to have enough ships or capes to move the iron ore and coal where it needs to go over the next several years?
Actually, it's going to be the supply of the product. So the supply, I think that the major miners are trying to keep up with the actual supply of iron ore. The world, unfortunately, is dependent on 2.5 countries to get its iron ore quantities, and that is Brazil, Australia, and to a lesser extent, South Africa and other places. So when you're heavily dependent on particular countries, that uncertainties arise from time to time, like the Brumadinho dam collapse in 2019, like the severe weather patterns that we saw in the beginning of 2020, also in Brazil. Unfortunately, we're dependent on countries that have extreme variations in their production and export levels. So I'm not concerned about the demand. I'm not concerned about the vessel supply. I think the demand and supply fundamentals are very healthy. A minor concern is how to keep up with the demand in respect of the supply of the actual product.
Of the actual product, okay.
Yes.
And when you look at, you're comfortable with the supply situation in the Cape market. Can you talk about some of the drivers that you're seeing as far as Cape supply growth over the next couple of years? We've heard a lot about uncertainty as far as not only shipyard capacity, but also regulation. You know, when you look at IMO 2020 or the potential future regulations. Can you just talk about the supply in the context of shipyard capacity and then also, regulations looking forward?
Mm-hmm. Well, there are various elements in the supply part of the equation. Number one, the most important is the fact that the conventional Cape-size new building pipeline is very low. It's one of the lowest historically. At the same time, we have some very old ships that are still operating, and it is inexplicable to a number of international Cape-size owners why these ships continue to be allowed to transport iron ore, especially from Brazil. There's about 11 million tons, deadweight tons, of converted tonnage that has been built pre-2000, so from 1992 and onwards, that have been scheduled to be scrapped over the last 2 or 3 years, but are yet to be scrapped. So we're really wondering why these ships continue to operate, big ships with deadweights between 250,000 deadweight tons and 400,000 deadweight tons. So the overall picture looks very, very good. There's another point to the supply that we think strongly that is going to put a lead on the new building ordering. 2 points actually. The first one is the uncertain regulatory environment because nobody knows what will be the vessel of tomorrow in respect of marine propulsion engineering and all these things. And also the big differential between a new building price and a second-hand price. So for example, we bought a 10-year-old ship, sorry, a 15-year-old ship at what we believe to be a record low price of around $11 million. A 5-year-old ship today is at around $30 million. A new building, high-quality new building ship stands at around $50 million, 51. So the price differential of a 5-year-old and new building is not justifiable by the incremental earnings of those ships. You need about 18 to 20 years in order to amortize the incremental value. So all these factors together, I think that will not push people to order additional tonnage anytime soon.
Yep, and then potentially even Stamatis, would financing play into that, the ability to finance new builds, or what's your view on sort of financing availability for the industry right now?
The biggest part of the current order book has not been by conventional owners. They are leasing-linked deals by the Chinese market. So in order for China to accommodate their demand needs for iron ore, they went out and built a series of bigger ships, Valemaxes, Guaiba-Maxes, and these kind of things. So they provide financing. If someone wants to, for example, get into this particular league and have a negative return on their investment, I'm sure there's going to be some sort of a leasing strategy for them in order to put this order. But in my opinion, nobody in the right mind should be placing any new building orders anytime soon.
And then you talked about scrapping and maybe potentially that there's a lot of pent up demand for scrap yards. India, Bangladesh, Pakistan, some of the scrap yards have been, dormant just because of COVID-19. Do you think once those countries open up for scrapping, that we're going to see more scrapping over the second half of the year, or is it going to take longer than over the second half of the year, more like a 2021, 2022 timeframe?
They will open up with scrapping. Eventually, the scrapping market is going to open up. Since the new building market and the shipyards in China appear to be operating in good order. For example, Seanergy completed a scrubber fitting dry dock during the peak of the coronavirus in China. So shipyards are working. They are taking care of the highest standards of operations. We have been, like I said before, completing dry docks and installing scrubbers between April and May of this year. So generally, I don't really see why the scrap yards will not open again. It's only a matter of time. If the shipyards are open and the repair yards are open, I don't really see how the scrap yards will not open, to be honest.
Yeah, and then do you think there's pent-up demand that there will be scrapping? Scrapping will pick up over the second half of the year once those scrap yards open up?
Well, it's a combination of events. I mean, first it's the actual performance of the vessel. If the vessel can perform, then I think that most of the owners in a healthier market will choose to keep the asset and exhaust, its operations as much as is possible. The classification societies that pretty much determine the seaworthiness of the global fleet, given the fact that the COVID situation makes it impossible for surveyors to go on board and all that, they kind of silently allow the fleet to continue to operate. So there's no heavy regulatory push for the global fleet to be scrapped. Once that comes into a point where the regulations will push ships out of the market, like they should be pushed when you're doing third or fourth or fifth special surveys or whatever that is, and the classification societies do not allow for additional extensions, I think we will see a new wave of scrappings taking place.
Yeah, now my understanding is that some of it's safety driven, that some of the older converted capacity potentially is not, for lack of a better word, being shunned by charterers. So effectively, there's no demand, and there's the likely outcome there is scrapping of those older vessels.
Well, I mean, yes, but there are certain long-term contracts between Vale in particular and the Chinese market that Vale continues to operate. So while Vale said prior to supporting all this new building wave between 2016 and 2020, they said that all these new buildings of the bigger ships were there to replace the older converted tonnage. So far, we've seen one ship have sunk right outside the Brazilian ports. There's another one a newer ship that got grounded and eventually sunk like a few weeks ago. Nobody's doing anything, and that's why, like I said before, it's inexplicable to us why there's no additional scrutiny on the safety of converted ships and bigger ships in particular. I think that this has to be expedited and prioritized so we don't see another negative incident into the market anytime soon.
Okay. And then, IMO 2020 was long discussed before implementation. It finally was implemented on January 1st. So we've, had a little bit more than 6 months of IMO 2020. What has been the biggest impact so far? And then if you look at it, with perfect hindsight or 2020 hindsight, what's your view on scrubbers right now?
Well, I think that right now the scrubbers is a totally uneconomical proposition. What was extremely misleading from the beginning is that the scrubber fitting was a paper exercise. So you just pushed the certain buttons and you would lock into certain spreads and you would make a certain profit. That is totally not the case. Installing a scrubber is an exercise that has proved to be very complicated. Maybe not for us, that we chose a better yard and better scrubber manufacturers in association with our charters, of course. But we really feel that the scrubber is a very difficult exercise for most of the fleet. The maintenance requirements of the scrubbers are tremendous. The additional forces and weight on the ship, as well as the operational fatigue that is a product of the scrubbers, is quite significant. So given that we're living into an era where sending technicians and service engineers on board the ship appears extremely difficult, in the event that something goes wrong with the scrubber, how are you going to fix it? There are hundreds of new piping connections passing through the engine room, and the equipment itself is quite, I'm not going to say sophisticated, but a very demanding piece of equipment in respect of maintenance. So from the installation point of view, I would be against the scrubbers. As far as the economics, people were anticipating that it's going to be a payback of 6 to 12 months, given a certain spread. That now has been 5 years. So I wouldn't really put a new asset. I mean, we did the recent scrubber fitting recently because we had a contract to honor with one of our charters, but I would definitely not be seeking additional scrubber fittings in the near future.
Okay. And then can you talk about your current fleet right now?
Yes.
And sort of how it's positioned from a standpoint of, maybe even an age perspective, and you built up the fleet over several different transactions. And then if you could talk about your recent move to acquire the good ship, and if you could just talk about how your fleet expansion is developing.
Yes. Starting with the fleet, we strongly believe that we have a very high quality, pretty much homogeneous fleet. There are a lot of sister ships, and we take really good care of our ships. I mean, from the beginning, the maintenance requirements and attention from me personally and all the executive team of Seanergy has been very, very strict. As far as the commercial allocation of the assets, as you know, we have gotten into, 6 out of the 11 ships are now operating under joint ventures with some of the world's largest miners and dry bulk charterers. So we have names like Glencore, that we have a long-term time charter joint venture of 3 ships, Uniper of Germany, and Cargill. Cargill has also invested on one of our ships in energy-saving devices, and we have been pioneering that kind of arrangement with Cargill, and we're looking to expand that relationship as well. So for us, providing the highest standard to our clients in respect of operations, maintenance, and the quality of the ships is of super importance. So that's top importance for us. In respect of banking, obviously Seanergy in the beginning of the year, due to the fact that the asset values have deteriorated a lot, became a kind of an over-levered company. Our leverage levels reached almost 100%. So what we had to do, and we can explain that further into this discussion, we had to really fix the balance sheet, either by amending and extending some of our facilities, and also by increasing the equity capital of the company. Right now, I think pro forma what we have done, and we just announced a very significant banking transaction today, where we have achieved a reduction of the debt with one of our lenders. Pro forma all that, I think we're in much better shape in respect of leverage and the long-term continuity of our operations in respect of the financing of the company.
Okay, and then the expansion of the fleet. You're potentially acquiring the good ship that might even be delivered by now. Do you see other opportunities out there to expand the fleet? And is that your focus going forward?
Well, we had the combined priority. I mean, the combined priority of Seanergy was number one, to deliver the balance sheet as much as we can, and all the capital that we raised from the recent capital offerings of the company were needed to be put in a good use. So what we have done, what we have achieved since we started our equity capital markets exercises, I must say, in April, was not only to buy a ship which is going to be delivered to us in the next 10 days, and we're going to pay on a cash-only basis for now, but also we have managed to deliver one of our existing facilities, and we are in discussions with other lenders to further deliver the company. So raising the equity capital and optimizing the balance sheet by acquiring a new debt-free asset and reducing the current debt, I think it's the best interest of the shareholders, and it increases the value of the company substantially. Okay.
When you look at the rate environment right now, it's been very volatile. This year seems to be almost a replay of last year, with very early year weakness that extended into the second quarter, and then a pretty sharp tightening of the market that moved rates significantly. We've fallen back a little bit. And I guess if you could just look at two aspects. One is, what do you think the rate environment looks like over the second half of the year with the pullback that we've seen over the last couple of weeks? And then secondly, how do you manage your fleet exposure as far as your contracts, floating versus, you have a lot of index contracts, as you mentioned before, but how do you manage those index contracts, and potentially do you try to fix rates to capture the improvement in the market?
Yes. Well, basically, having the fleet either spot or in index link gives us a tremendous opportunity right now to capture the significantly improved market. Obviously, like all the other shipping companies, we suffered a lot in the first half of the year. Both Q1 and Q2 were very weak in respect of earnings, not just for us, but for the majority of the listed companies and the spot players out there. But right now, we are basically taking full advantage of the market, and from an average of $6,000-7,000 for the first half, suddenly we're at above 20. So that by itself gives us a tremendous opportunity for the second half of the year to deliver very good returns for our shareholders. Regarding your question about spot and fixed coverage, as you know, in most of our contracts, we have the ability of converting floating to fixed. We have already done that a couple of times this year, and we will continue to play that strategy, which is, of course, a short-term strategy. I mean, you can fix anywhere between a few months and 12 months. So this is not like a 2 or 3 year long-term strategy. I believe that when the expected long-term sustainable recovery happens into the market, where the 3 and 5 year time charter rates will be above the weighted average break-even levels of the company, we will be fixing more and more assets on the period, on a longer period of time.
Okay, and then you alluded to before your capital markets activity on the raising equity, raising cash through equity issuance. Can you talk about in the context of what you're doing on the debt side too? Congratulations, earlier this week you were able to finalize the refinancing of the refinancing of the debt that was due, that's due at the end of July, and you do look like you're going to book a pretty significant gain there that's accretive to shareholders. Can you talk about that transaction that you were able to accomplish, and then also talk about, over the second half of the year, you have another tranche of debt that's due later in the year, and sort of how you're going to handle that?
Yes. Well, while everybody was living in lockdowns and the severe effects of the COVID, we have been extremely busy, myself and the whole management team of the company, in producing some amazing transactions. Number one, we raised the equity required for the company to sustain a very, very difficult market environment, one of the worst of the last 30 years. And on top of that, we used this capital to buy a ship on a cash-only basis. And we started active discussions with our lenders to see how we can basically restructure the upcoming maturities. The first lender that we started discussions with was back in February, where we amended and extended the facilities until 2022 and later, so that was absolutely fine. The second lender that we started discussions, we offered the alternative to either amend and extend, or to potentially exit at an agreed reduction. They chose the second option. So instead of amending and extending the loan facility for another 2 or 3 years, they took the opportunity, and we took the humongous opportunity to get out of this facility with a material reduction, which is in excess of 20% of the outstanding indebtedness. Regarding the other lenders, we are in some very positive discussions right now. There is very strong traction in providing a good result, and I think in the next few weeks we will be coming out with some good news about the remaining indebtedness of the company that matures in 2020.
Can you talk about how you were able to manage to get such a discount from the existing lender? And then secondly, Stamatis, if you could talk about the impact on your break-even costs, that would be great. You might see a little bit higher interest rate on the refinanced debt or the new facility, but certainly your amortization schedule might be a little friendlier than the previous facility. So can you talk about sort of the net impact on break-even costs?
Yes. On a pro forma basis, I'm not going to stay in just one facility right now, but also what we believe to be the outcome of the discussions with the other lenders. I think that the overall financial break-even of the company upon conclusion and thereafter will be reduced by maybe $2,000 a day. Again, I'm being a little bit careful in providing this kind of guidance, but I think that we will be able to get into a situation where we will reduce our financial expense. Obviously, we look at the balance sheet, and especially the liability side of the balance sheet, on a more holistic perspective. Yes, the new facility might have a higher interest rate, but given the fact that we have reduced the indebtedness and we have lower principal installments, that not only breaks even, but produces a big gain for the company altogether throughout the period. So that's how we see things. Also, given that our overall indebtedness is reducing and we expect it to reduce even further, the interest expense is also going to be reduced. I cannot really give you a number because there's too many apples right now on the air. So I will try to be a little bit cautious. Let's stick to that guidance number of around $2,000 that I think the financial expenditure is going to be reduced. And, but again, I'm just trying to be cautiously optimistic here when I provide this kind of numbers.
Could you comment on sort of your liquidity and pro forma for the equity raise and also the acquisition? Are you comfortable with your current liquidity or your pro forma liquidity? And then maybe if you could talk in the context of, would you consider a stock buyback or a share repurchase program? Is that something that investors might expect coming out of Seanergy over the next several months?
We're generally open to various ideas, and we have considered all actions. Like I said, we are in active discussions with a number of our existing lenders right now to try and improve the overall financial standing of the company even further. So the answer is yes on a long term, and we will discuss this at the end as to what I think is going to be Seanergy of tomorrow. Right now, our primary target is to reduce the indebtedness of the company, delever as much as we can now, and have a certain structure in place that will be able to deliver sustainable return to the shareholders in any given market. But we will discuss that at the end later on.
Okay, and how important is your charter profile? You mentioned Glencore, you mentioned Cargill. Is that something that is a strategic focus for you? And then maybe you could highlight potentially that how much fleet availability you will have over the next year or so. I mean, have we seen the bulk of the shipyard activity over the last year take care of the next couple of years as far as idle time? Sort of if you could just talk about how you expect fleet availability to look like over the next couple of years.
In 2019, last year, we had about 7 dry docks in place. So that took away a lot of availability. Thank God the way that we position things, we did not lose substantial time from the second half of the year, last year, because of the timing of events and the arrangements with the charters. I mean, in most of the scrubber installations, we had agreed with the charters that they will be paying us for the biggest portion of the idle time. This year, we have a minimal dry dock, maybe 2 ships that will happen later in the year with no additional scrubber fittings. So these assets will not take away the earnings capacity, substantial earnings capacity from the company. So I cannot really put a number, but it's going to be a minimal impact on the available ship days for revenue generating of our assets.
Okay, and then you had the overhang of the minimum bid closing price of under $1 for a while. You had a deadline of I think late September to remedy that situation. You moved forward with a reverse split, at the end of June. Why did you do that earlier than you had to? And then maybe talk about how important regaining the Nasdaq listing without the overhang is.
Yes. Well, first half of 2020 was a very bad year for the Capesize market, for the dry bulk market, and for the global economy. We chose to try and put all the bad news associated with a bad year away, and that's why we wanted to do and recover the Nasdaq compliance earlier rather than later into the year. Obviously, we could have waited until September, but we decided, and I think the board took the view that we'd rather do it now instead of waiting 3 or 4 months later in the year. So it's just a matter of timing, and it's a matter of associating this move with a potential bad part of the year, to put it this way.
Okay, and then when you look at your stock price, you said in the past that you think it's trading well below net asset value. Do you have any plans, or what do you think you can do to help close that gap versus NAV? And then also, why do you think the stock is undervalued right now?
As far as the management is concerned of this company, we're doing literally some of the best transactions that have been presented in all of our peer groups. So, if you compare Seanergy with other companies that have been raising capital in abundance over the last few months, we have not done any related party transactions. We bought a ship from a third party at the lowest point of the shipping cycle for a cash-only basis. We have managed to reduce our indebtedness. So we have tried to put an excellent use of that capital that the shareholders entrusted with us. And we will continue doing so in the future. So for us, it's of paramount importance that the new capital associated with any equity offerings that we have done is put in the best use possible instead of just, issuing shares for the sake of issuing shares. So I don't really want to give a guidance into where we're trading right now or what I think is the fair value of the company or anything like that. All I can say, and this is proven by our, the capitalization tables that we have announced, Seanergy has a much bigger presence and total enterprise value compared to what it used to be in the beginning of the year. So we want to further increase the value of the company as much as we can. We are delivering some amazing deals to the market and to our shareholders, cutting debt, buying ships, and things like that. So overall, I think that we are doing all the right steps that we need to do. Now, from a technical perspective, such as dividends, stock buybacks, or things like that, given that we went through one of the lowest periods of the dry bulk market ever, I want to be a little bit cautious about the liquidity of the company, because even though I find it extremely unlikely to happen again, we might get into a situation where rates go back down to $0 or $2,000 a day. So our initial decision to start raising equity was driven by the fact that the market was between $0 and $2,000 a day. Any company in the world that had access to liquidity at the time, regardless of shipping or whatever, actually maxed out their liquidity requirement. So, this is what we did as well. In a market recovery environment like we stand right now, we have put this capital in some excellent deals. So, this is the kind of delivery we have always done for our shareholders, and this is what we continue to be doing in the future.
Okay, great. And then if we can take a broad brush and look forward, Stamatis, can you share with us your vision of Seanergy going forward and sort of what your goals are over the next several years?
As I briefly touched upon a few minutes ago, what is important for us to achieve is to have, first of all, a top quality company as far as our assets are concerned, so we can deliver an excellent transportation services to our clients. So for us, this is of paramount importance. Good ships with good charters and sustainable operations. Most importantly, from a financial perspective for our investors, we want Seanergy of tomorrow to have the ability to return value to the shareholders on a sustainable basis without ups and downs or the cyclicality of the market. So we want to create Seanergy to be in a position, we want Seanergy to be in a position to deliver shareholder returns in good markets or in bad markets, and basically have a sustainable return of capital to its investors, regardless of the cycles.
Well, we've covered a lot of ground, and I really appreciate your time, Stamatis. Here's to looking at a stronger second half of the year and looking into 2021. I think we touched on all the major challenges that Seanergy faces and their ability to address those challenges from a more positive standpoint than at the beginning of the year. And so I just want to thank you for your time, and thank you for joining us in our CEO interview program series. Have a great afternoon, and thank you so much.
Thank you very much, Paul. It's great to be speaking to you again, even from through camera. Thank you.
Hopefully in person at some point in time over the near future.
I would love to. All right. Bye-bye.
Oh, this was a great interview. Couple of quick questions. First of all, can you explain what IMO 2020 is? There were some
Sure.
references about the regulatory environment.
Yeah, sure, Mike. It was essentially a regulation that was worked on for a long time and then finally implemented on January 1st of 2020, hence its IMO 2020. It mandated the use of low sulfur fuel unless you installed scrubber systems, or essentially systems on board that cleaned or scrubbed the sulfur from the emissions flows.
It sounds like he wasn't all that excited about the scrubber systems themselves and implementing them. What you had a couple of questions related to that. I was wondering where were you going with that?
I think essentially what a lot of the investment rationale for installing scrubbers, which could be in the $3 to $4 million range per vessel, was based on expanding fuel spreads. In other words, the cost of high sulfur fuel versus low sulfur fuel would expand so that it would be economical to burn essentially high sulfur fuel, and there'd be a major advantage. While initially it did expand, it since maybe because of COVID-19 and maybe because of oversupply in the oil markets, the spreads have collapsed and compressed. And so the economics aren't as attractive now as they once were for scrubber installations. And so I think what Stamatis was saying is that in a perfect world, if you had the current information now, 7, 8, 9 months ago, he wouldn't have installed scrubbers on his fleet. I think the good thing with their program, though, is that they had clients or charterers who were willing to pay for installing the scrubbers, and also willing to compensate them for some of the downtime they incurred to go into the shipyard to install the scrubbers. So, they did have a unique way of installing scrubbers, and I think it still will probably work out to their advantage if you look out more than a year out.
Gotcha. And it seems like this was a stock that was well over $300 per share just 2 years ago. And it seemed like maybe the company got a little ahead of itself with debt. And so there was liquidity concerns. Can you talk a little bit about those issues, and maybe the fact that he talked a little bit about his debt refi? Maybe if you can touch on what your thoughts are about that.
Yeah, first of all, they did have a leveraged balance sheet. They had made a couple of acquisitions over the last several years using debt, and the market had not recovered as quickly as they expected. So, while they were at times above break-even costs, they didn't generate a lot of cash. So the debt was never didn't go down as quickly as they hoped. And then when they looked into last year, the first half of the year was weak, and so they did have to issue equity to essentially enhance liquidity and raise cash. And essentially the same thing happened this year when we had a very weak market over the first half of the year, including the Baltic Cape size index going negative both in the first quarter and the second quarter. So they did have to issue equity again, not only to maintain liquidity, but they did raise enough equity actually to make an acquisition. And so they announced an acquisition a couple weeks ago of an older Cape size. So they did grow their fleet. So while a lot of the equity was dilutive and only essentially went to maintain liquidity and get them through the trough in the cycle, they did raise enough where they did expand their fleet by 10%, and that should be a positive event going forward. Now, when you look at the debt refinancing that they did earlier this week, they have a commitment for new money of about $23 million, and they had debt that was going to mature at the end of this month for about $29 million. And the existing lender actually took a haircut and they only had to repay just about 22.5 or 22.6 million. So they did realize a gain of about more than $6 million, and so that is a positive from the standpoint of refinancing their existing debt that was due at the end of the month. On top of that, it should have a positive impact on their cash break-even costs because the debt amortization schedule will be stretched over a longer period of time. And they do have, probably covenants that are less restrictive than their older credit or their old credit facility. And also, Stamatis talked about upcoming maturities that are due at the end of the year. And while they don't have, the actual agreements in place yet, it sounds like negotiations are already underway to refinance that debt. And that would also be positive from the standpoint of lowering their break-even costs by essentially reducing their annual debt amortization requirement.
It seems like rates are coming back dramatically, and at the same time, they're getting control over their refis. Is the worst behind this company now, do you think?
I think it is, from a standpoint of that they do have, I think, sufficient liquidity. They've moved forward with making an acquisition at a reasonable cost when you look at the historic cost of that acquisition relative to the last 5 years average as far as 5-year asset values. It's attractive. On top of that, they have refinanced the first maturity that was due in 2020. They're making progress on the second maturity that's due at the end of the year. And so I do think that when you look at the company from a standpoint of being able to benefit from what we think will be a tighter market going forward, I think they position themselves, to capture the upside rate volatility. And when you look at the market, the broader Capesize market, supply and demand, in my mind, are very close. It's pretty much showing us that while rates do go down a lot when demand falls off for whatever reason, whether it's seasonal or whether you have issues on iron ore mines in Brazil like flooding or dams, essentially dams breaking, you do see rates that are lower. But rates quickly, not only in 2019, but also in 2020, rates have rapidly gone up and recovered. And so I do think the market is tighter from a supply demand standpoint than a lot of investors believe. When we look at supply growth too on the fleet, the overall fleet, the order book is one of the lowest that we've seen based on a historical level. It's in the single digits. On top of that, there's uncertainty as far as regulatory issues going forward. What kind of propulsion systems will be best over the next decade to meet what are likely to be tighter emission standards going forward, starting in 2020 or 2030. And so I do think at the same time, the financing environment is tough as far as trying to get new capital coming into the industry. So I do think a lot of the ingredients to keep supply growth lower there. And if you have the least bit of recovery or positive news on the demand side, rates will respond accordingly.
Well, Poe, thanks very much for this interview. It's very insightful. And we encourage you to look for more of Poe's research on channelchek.com. And of course, this was Seanergy, stock symbol SHIP. Thank you again, Poe.
Thank you, Mike.